Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, Inc., New York's window company, Capital One Bank, Greenberg Traurig, LLP. Additional funding for this program is made possible by grants from AVR Realty Company, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, F.J. Siami Construction, Friedman LLP, Gemini Real Estate Advisors LLC, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, M&T Bank, Markham LLP, Marcus and Millichap Real Estate Investment Services, Meridian Capital Group, The Moynihan Group, Margolin Weiner and Evans LLP, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling Inc., Stonehenge Partners, Urban American, The Wickoff Group.
Hello, my name is Michael Stoller. So we're here in the summer of 2010, and I hate to say, I believe there's irrational exuberance. I think people, all they want to do is buy. They want to buy properties, they want to buy ownership. So I don't know what really is happening in the investment sales market. So I assembled these four demons, these kings of the investment sales market, to provide me and my audience insight on the state of the market. My guests, they include Robert Knackle, the chairman of Massey Knackle Realty Services, or I should say my co-host for being here so many times. Peter Habsburg, the chairman of Easton Consolidated. John Kaplan, the executive managing director at Jones Lang LaSalle. And last but not least, a former MAI, always an MAI, the executive vice president of the Capital Markets Group at Cushman & Wakefield, Franklin Antonio. Okay, since you are an appraiser, an area, where you have to value things, what's happening? What do you see values today? What's happening?
It's a function of supply and demand. It's very simple, Michael. You have a lack of product in the market today, so you have a very limited supply, and there's an abundance of capital, and there's a lack of alternatives in the investment market, which has performed so poorly, and I think there's an incredible amount of competition for product today.
Is it, Peter, is it all product? We were talking prior to the show about this property on 35th Street. I mean, things that, 2008 was bad. 2009 got a little better, but it was still bad. I mean, where do you see 2010? I mean, is it the product? Is it people having the desire? Or is it cutting coupons? They said, I'm only earning 0.25% in the bank. What do you see?
I don't know. Looking back, though, I think it was really second quarter of 09, which was the darkest part of the market. And I think it's not hard to get exuberant with 2009 gone. But as Frank says, it's just the capital has been waiting on the sidelines for 2 years now. And if anything, it's just built up. And the few assets that have now traded have just traded at remarkably strong pricing because of what Frank says.
Now, prior to the show, you said that, we may have a double dip. 2011 may be a bad time.
Well, if you read the news reports, the amount of the $1.5 trillion of CMBS and other debt, and Frank, of course, was discussing that the FDIC hasn't yet become a player. If you really look at those figures, you could see an enormous amount of property dumped out in the market with not nearly enough debt to refinance it.
Mr. Bob,
Yes,
what do you
Michael.
see?
Well, I think it's interesting. I think that clearly the acute supply-demand imbalance is something that's driving pricing. But as transactional people who rely on deal volume for a livelihood, It's very important to look at the volume of sales. We went from, in 2007, we had over 5,500 properties sold in New York City. Last year was only 1,439. And I think one of the interesting things, as Peter points out, about a potential dip in the future is that we estimate that there are about 15,000 properties in the city with negative equity in them today. Even if only 10% of those came to the market, it would effectively double the supply of available properties. So that would exert downward pressure on prices moving forward. I don't think that that's likely to happen in the short term. I think for the balance of 2010, I think the market's going to be in very good shape. Prices are at a point at which buildings are selling for more than their economic fundamentals dictate they should be selling in today's environment. That's likely to last throughout the rest of the year, but after 2010, it'll be very interesting to see how it goes.
Yeah, but you know, we hear the term replacement cost. You know, if I can buy it for below replacement cost, all this. But you know, it's not. You have to have economics. You know, at one time, going back in 2007, you would sell a building because it was vacant. That's what you wanted. You wanted a vacant building. You can get the highest rent over there. And then in 2009, no, it has to be 100%. It has to have good credit tenants and so on. Now, 600 Lexington Avenue sold with potential roll-off over there in a couple of years. Where do you see this, Mr. Kaplan?
Well, first of all, I think you need to look at it in the context of what are your alternatives. If you're if you have money in the bank, you're getting less than 1%. If you buy a 10-year T-bill, you're getting in the threes. And if we're talking about these high-priced deals that are in the 5 and 6% cap rate ranges. Compared to what you get on your money in alternatives, that doesn't sound so bad. Plus, you have appreciation. Then you also compare it to replacement costs.
Appreciation, when somebody paid $1,550 for 450 Park Avenue, there was an appreciation, the value reduced. The question is, what's appreciation? The appraiser, the man who's been involved, goes up and down, right?
Right, but at the same time, the top prices that we've seen, the recent deals have been in the $500 to $700 square foot range, so well below replacement costs for New York City properties. So it's, I think that in that respect, there is room for appreciation, and also we're starting to see, a return on the fundamental side, where we've sort of turned the corner in the leasing market. Our employment picture has been much better in New York than anyone expected at the beginning of 2009. Our unemployment rate's well below the national unemployment rate. So I think that people are searching for, relatively speaking, a safe harbor, both from an economic and political standpoint. And New York, being an international gateway city, is benefiting actually from, I would say, more uncertainty on a global basis.
But the city and the state are in trouble, financially. And so you buy an asset, you buy a piece of real estate, and you buy multifamily. Let's use that as an example, because that's one of the specialties that both of you do a lot of it. Okay, and you buy the property, and the real estate taxes go up. That's going to change your return, your cap rate.
That's the elephant in the room, is what's going to happen to real estate taxes. And already now people are screaming as they open their new tax bills, and with the budget the way it is, the next couple of years are.
So that's my point. You talk about a return, but that's a return before the real estate taxes. And then another person might say that's a return before the water and sewer. And so when you take those things into consideration, it's truly nicer that this year landlords are not giving 2 months free rent, 3 months free rent, and now they're changing the numbers. But it was only a year and a half or 2 years ago that landlords, even in the Bronx, Larry Gluck said, and the other people, you know what? I had to reduce my rents for people living in the Bronx, and you never thought they would, because the apartments were reasonable. But somebody who's getting hurt by the recession is going to have that problem.
Yeah, Michael, the two biggest risks in the capital markets moving forward are interest rates and real estate taxes. Clearly, we saw tremendous fluctuation in the 10-year T-bill rate, where when the Fed stopped its asset buying program, which it did at the beginning of April, we saw the 10-year shoot up from 3.5 to over 4. And as soon as the problems in Greece and Europe started to really come to light, we saw the 10-year plummet. It opened this morning at 322, which is unbelievable that it's at that level. So actually, the distress overseas is helping us indirectly by keeping our rates low. But real estate taxes, as Peter points out, municipalities all over the country, and particularly here in New York, we have a $9.2 billion budget deficit in New York. You have to imagine that taxes of all kinds are going to go up. Real estate taxes are an easy target, but state taxes, local taxes, and that's one of the big reasons why employment growth hasn't really taken hold the way it really should have.
And I'll give you a situation. I have a son living in Chicago, and we went to bring some food in from takeout, and I looked at the bill, and I saw the sales tax, and I said, 11.5% sales tax? And that's what's, we're at an 8.75% rate now, and how do you take care of it? You increase your sales tax. People go up there. It changes the way. It has an effect on your retail. It has an effect on your purchasing and all the rest. So I think, even though there's this exuberance on that situation, it's happening. But you know what? I think there was an important comment that we made prior to the show. Let's not look at Manhattan Island only as the place. Let's talk about, the other markets, the boroughs of Brooklyn, Queens, Bronx, and something called Staten Island that nobody thinks of, but we do have viewers in Staten Island, and in Long Island. Because, there was the situation that took place, I think, about a month and a half ago. Guardian Life Insurance Company sold the building for $45 a square foot, way below replacement costs, as you would say, in Garden City. It was built in 47, was converted in 73, but it was 73% vacant. And Nassau County has probably the highest taxes around. So, so
It's a big
Manhattan,
disparity, isn't it?
yeah, it's a major disparity. $45 a square foot.
Yeah, I mean, there's a lot of disparity in terms of, core product versus non-core product, but also geographically. New York City, Boston, D.C., L.A., Orange County, they've held up extremely well. But in other markets,
I mean,
yields are much higher.
You represent, your region is national, plus the Greenwich, and you lived up, in that marketplace. Greenwich is hurting. Westchester is hurting. You're not able to sell properties in the same value, even following this approach of replacement cost, because the rents haven't gone up.
No, and there's no prospect in the near term either.
One thing I think we're forgetting, though, when you look at real estate as an asset class is two things. Number one, it's the duration of the ownership. Okay, what is your time horizon in terms of ownership? And number two, we've all been talking about all of the pressures that's on the financial system that is keeping interest rates at 3.22% for the 10-year bond, and the expectation is that it's not going to go above 4 between now and the end of the year. But there's this vast amount of debt, deficits for the city, deficits for the state, and the federal government, which is ultimately going to put us into an inflationary environment. And if you look beyond the next year or two and look out to a 10-year time horizon, real estate becomes a very attractive vehicle for investment because of its ability to raise rents in tandem with inflation. And we've been through inflationary cycles
With the
past.
exception of the state of New Jersey and the exception of Connecticut, Westchester. Because the office rents in Westchester have not gone up in 20 years, and the office rents in New Jersey have not gone up in 20 years.
Sounds like Dallas.
No, but if you follow Frank's point, 450 Park at $1,500 a foot in 7 years might look like a very smart deal.
Yeah, inflation is a double-edged sword, though, because while rents will escalate, with inflation comes higher interest rates. With higher interest rates comes higher mortgage rates, which means cap rates have to go up, which means that will exert negative pressure on value. So it really depends. If you have an asset that has turnover such that you could take advantage of increasing rents, but yet you have debt that's locked in at a fixed rate for a relatively long term, then you enjoy the inflationary period.
What's nice now, helping all of you in the investment sales, is the fact of the low rates, the low interest rates, and also the fact that the banks who are strong are out there, and the insurance companies, and I said, the world of CMBS is returning. Not really right, but it is returning. Last week, Chase Manhattan did a $733 million CMBS on a variety of properties, including Ladder Capital, Ladder Financial. So, financing is helping this market. Every bank I know loves multifamily. It's the flavor of the week. It's been a good thing. But vacant land. What's your thought about vacant land? Anyone want to you had mentioned
Well,
56th
last year
Street.
you didn't think we could get an offer on a hotel site in Manhattan, but you know, we recently closed a corner of 56 and Lex at $390 a foot, which is a number I thought I wouldn't see for another 10 years.
But what about today? Other sites? I mean, everybody. I remember you selling a lot of property in the Highline area. You had property, land over there. You know, anything. You know, do you see that happening today? You were talking about the property that you were trying to sell last year or earlier this year on 57th Street, the small little
This
lot.
year, yeah, we had a small mid-block site on 57th Street between 5th and 6th, and we had interest in the $250 per FAR square foot range. And I think that, you know, land is highly variable. I mean, if it's a secondary, tertiary location, it may be tough. But if you have a good location, a good core location in New York, those are very rare, and therefore there's still demand, even if people are going to land bank them for a little while before
Yeah,
they
Michael,
develop.
And I think that's the key.
Yeah,
It's-
what's really interesting is that for the first time in years, people are starting to underwrite based on condo potential, which is really remarkable. When we look at distressed assets, most of them that have come to market so far have been in the form of distressed development transactions that are either partially complete or haven't even come out of the ground yet. For 2 years, we were underwriting values there only based upon a rental scenario. And for the last month or two, people are starting to underwrite for a condo sellout again, which is remarkable. And that's going to help land value significantly. Because there's a big difference between value of land for
the only
rental
question
versus
that I
condo.
have with regard to the condo situation is that land was sold for residential purposes because of 421A tax benefits, and that provided, you know, the buyer of the apartment didn't care. They said, "No, I'm paying this, and in 10 years I'll pay it," and then they worry about it later on. But now you don't have the 421A, so your real estate taxes are up higher, and people, you know, when somebody buys something, they have to say, hey, what's my monthly payment? And if they don't have the 421A, then the price has to be lower because they have a budget on where they are.
Sure.
On that situation. You know, I agree, but I don't see the lenders talking about condo development unless there's a lot of equity in the deal on the condo development.
Well, that's what's happening these days. They're all 40, 50% equity deals. There's plenty of equity around for this. And as Bob pointed out before, if you're coming online with a condo in 2 or 3 years, you may be the only guy in the game.
Now, what about, you know, there was the sale this year of the Carlton House. I think it was, you know, and there was, everybody wanted it. I mean, because you had great retail and you had great potential on the condo co-op because it's under a land lease.
Right.
That went at numbers no one would expect at the beginning of the year, right?
Well, that was a great example of location rule. You know, there's been so little available in a location like that was quite a party over there. No one expected those numbers.
And we've seen more resilience in the certain types of special locations for top-end luxury residential. That certainly fits into that kind of category. So I think that there are not a lot of sites like that in the city.
I think another area which is really interesting, it's retail. You know, the Takashimaya site was recently acquired, and now it's on the market. The retail at 666 Fifth Avenue, especially with the Uniqlo lease over there, you know, the $30 million over there. Where do you see retail for retail purchases for investment sales? You see a lot of active people looking for retail?
I think there's a great demand for that. I mean, here again, I think it's a lack of product, and the product that comes on the market is very aggressively sought after.
Still very low cap rates.
Very low cap
Yeah.
rates, absolutely.
But we've
Absolutely.
seen a very volatile cap rate environment over the last couple of years. It used to be 3 years ago, we could sell any retail property or retail condominium at a 5 cap, whether you had a AAA credit tenant or it was Sam the discount man was the tenant. It was a 5 cap. We saw, based on consumer confidence levels falling, consumer spending falling, retail was very adversely affected. Value in the retail sector fell by 46% from the peak. And we saw cap rates getting up into the mid-7s, even for prime Manhattan retail. Now they're back into the 6s and even sub-6 in some cases. So that's been a roller coaster ride relative to the retail properties.
Yeah, we're seeing it in the 5s and 6s, and we handled a retail sale about almost 2 years ago that was and 8%. Now, it was a ground lease, so that might have knocked up the cap rate a little bit, but it wasn't, not substantially.
I mean, if you're a retail, if you're buying a retail space, look, you'd like to buy a TD Bank or a JP Morgan or something like that, because hopefully they're not going to be going out of business. But I think what you did say is, Sam, the retailer, they're not looking at that situation. How are the outer boroughs reacting today? How's Brooklyn and Queens today? New York City on retail is still under retail, so it's an urban business. But how are the residential doing, industrial or land in the other boroughs?
Very, very different. Pricing's not nearly as strong. It's still depressed.
What do you attribute it to?
Well, there's no condo sales going on at all, no prospect of it. They haven't rented up the existing product that's there. So, land prices, I'm not sure what they'd fetch in Brooklyn.
In terms of coming out of the recovery, clearly Manhattan is going to lead all the boroughs. Yeah. It always has, it always will. We've seen in Manhattan 5 consecutive quarters of an increase in sales volume. But in the boroughs, sales volumes have still been decreasing quarter over quarter. The good news is that they've been decreasing at a reduced rate each quarter. So it's clear that we're getting to a point of stabilization, and we expect that within the next quarter or two, we're going to start to see an increase in the volume of sales in the boroughs. That's just, that would be a natural occurrence.
Should be, according to the real estate board last week, there were 570 stalled construction sites in New York City still, so there's an awful lot of product to work through.
Here's a question before I have 2 questions. One is, since you're an international firm, do you see the foreign buyers coming to you and asking to buy looking for property?
Oh, absolutely, absolutely. We have a steady drumbeat of foreign capital from Korea, from China, from the Middle East, from Israel, from Germany, from France. I mean, there is clearly, and even
nothing from Greece and Spain these days.
No, Greece and Spain are on the sidelines, but no, there's a steady drumbeat, and I think as you look at some of the larger assets that will ultimately come on the market, they have the capital, the capacity, and in many instances, the desire to outbid.
Yeah, Michael, and if you look at the foreign interest in New York City, I think it's fascinating that most of the properties that we've sold in the under $100 million segment to foreign buyers have been to buyers who don't consider real estate their main business. They've made a lot of money in other businesses.
Like Carlos Slim, who buying 417 Fifth Avenue.
These investors are saying, look, on a relative basis, the United States is relatively politically stable, relatively economically stable. The dollar has been relatively weak, although the euro has been dropping quite a bit. But they're saying, now is the time to get in and buy a piece of property, particularly in the Manhattan market here. And most of these acquisitions are being done without any debt at all. They're 100% equity purchases.
Now I have a question which relates, it partially relates to Peter's comment that there are 527 stalled sites. There are other things. Everybody, as I was saying prior to the show, everybody wanted to buy a note, and they didn't understand what goes into a note. What do you see happening in the investment note market, people buying investment notes?
We formed a distressed debt division 3 years ago because you could sort of smell what was happening, but really didn't transact until the last quarter of '09, and now we've probably done 15 note sales. But as you say, they're problematic, but there is certainly a whole crowd of investors out there that are perfectly ready, willing, and able to deal with the issues presented by notes.
Now, my question is, how astute are they? A lot of people want to buy a note, but as there's a lot to foreclose on a note.
Yeah, Michael, I think you hit the nail right on the head with that point. I mean, we have on the note sales that we've done, we've had over 50 offers on every note sale. And I would say that probably 20 or 25 of those 50 could actually perform on acquiring the note. A lot of these transactions are false starts. And as an intermediary, a big part of what our job is try to determine who actually has the ability and capability to do these note acquisitions and who can't. And for those that can, it's been remarkable the recovery that banks have been able to achieve on these note sales relative to collateral value. It's been very high.
Now, but the other problem with the note sale is that there aren't that many sources who are going to finance the note sale. So it comes back to what you were saying about foreign buyers. A note purchaser has to come up with cash.
Although
Yeah,
I'd say
there's-
with the foreign buyer, you know, you've got the issue of not being familiar with or needing to have a partner here locally, because the foreign buyer doesn't know the court system, doesn't, you know, may have an expectation that they're going to get control of the property within a much shorter period of time. And as you know,
What I
in
think,
New York-
which you're relating, is the foreign buyer who's looking at a note, who wants to buy a note, is really teaming up with a local operator.
Right.
You know, and they're working a pari passu or a certain type of joint venture where the operator who's going through the foreclosure, because that's what it is. I mean, unless you make a deal with that person who you're foreclosing on, a friendly foreclosure, it could take 1, 2, 3, 4 years to get to the property.
I haven't
Yeah, in
heard of many
addition-
examples where the foreigners have partnered on a purchase of a note sale.
Yeah.
No, we haven't
This
seen
is
that
mostly
either.
local families, and they're all equity purchases, and
We talked to a lot of foreign buyers, and I agree with you. I mean, most are not interested in note sales. Now, we have talked to some who are, but they're interested in partnering. And I think that partnering provides advantages for a couple of reasons. One is there's the expertise, as you alluded to, and also sometimes the process happens so quickly that it's harder for, in a managed bid process, sometimes it's harder for foreigners to compete on that basis.
So with like a minute left, what do you think, you know, last year, as you said, the last 6 months of the year, let's forget. Thank God it was a bad dream, as I wrote in an article. Must have been a bad dream. How's the year going to close? Are we going to be up 40% over last year?
40 or 50%.
probably the same.
In New York City, I think we'll be up about 150%.
150, boy.
Yeah.
Mr. Frank, what do you think?
I'd say at least 100%.
Just to qualify, my 40 or 50 deals with number of properties sold, not dollar volume, which I think John's
I'm
gonna be
talking
more on
dollar
track.
volume.
I'm talking
Dollar
dollar
volume, I
volume.
think
Dollar
could be the
volume.
150, but
We had-
number of buildings sold, 50 to 60.
Well, dollar volume. is
So
what-
I'd like to thank my 4 gurus who have provided me and my audience insight on the investment sales. I'd like to thank Bob Knackel, Peter Habsburg, John Kaplan, and Frank Lee Antonio. See you next week.
Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, Inc., New York's Window Company, Capital One Bank, Greenberg Traurig, LLP. Additional funding for this program is made possible by grants from AVR Realty Company, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, F.J. Siami Construction, Friedman LLP, Gemini Real Estate Advisors LLC, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackel Realty Services, M&T Bank, Markham LLP, Marcus and Millichap Real Estate Investment Services, Meridian Capital Group, The Moynihan Group, Margolin Weiner and Evans LLP, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling Inc., Stonehenge Partners, Urban American, The Wickoff Group.